Did you know that the stock price that you see on the stock chart is not actually the price you necessarily should be paying for the stock? People oftentimes make the mistake of buying stocks when they're expensive, and we're going to dive into that topic today. You're listening to Investing Mastermind Podcast. I'm Signe and
I'm Michelle Markey.
In today's episode, we're going to dive into stock prices and intrinsic values, which all sounds very, very difficult to understand. But don't worry, we will try to break it down. Because one thing I've noticed is that when people are talking about that a stock is expensive, it is because the stock in itself, the full price is expensive. Like, for example, a stock that costs $1,000 is expensive, whereas a stock that costs $3 is cheap. However, that's actually not what you have to look for, because $1,000 stock could be actually a cheap price to pay, whereas a $3 stock could also be extremely expensive. So let's dive into that topic today. An example we could start out with discussing, Michelle, is, the whole Gamestop debacle a couple of years back, which is a typical example, in my opinion, about is the price of the stock always correctly valued? And as you might remember, Michelle, back in the day, the stock price of GameStop increased within just a few days. And after that, it just totally lost value over the next couple of days. And the reason why it went up was because there was a lot of chatter out there on social media that this stock was a stock that investors should buy and that traders should go into this stock to support the business. But the stock price of GameStop wasn't necessarily correctly valued throughout that period. So it's a good benchmark to use. Michelle, do you know about that whole GameStop?
For sure. It was the meme stock craze. And during the pandemic years when people were stuck at home and wanted entertainment, they would talk about some of these things. Like it kind of coincided with a lot of factors, like people being stuck at home and a lot of the brokerage operators not having commissions anymore. So a lot of people just use their brokerage accounts to buy in and out of stocks. And one broker called Robinhood was especially encouraging people to trade a lot with some of their app features that applauded people taking action. So if you bought or sold a stock, you might get confetti or something like that at the time, which made it seem game-like, but people were using real money, and it wasn't supposed to be gambling, but a lot of people treated it like gambling, and they would say things like YOLO for, you only live once, and
HODL.
yeah, and
Instead of
hodling.
hold.
Yeah, like hodling and diamond hands or paper hands and all that, fun lingo that came out at that time. And I mean, there were so many people who believed in this idea that they were going to take it to the bad guys on Wall Street, which maybe they did to some extent at the time, because there was someone named Roaring Kitty, or, has another name, Deep something value, that was pretty known at the time. And I think there's a movie coming out about this story where this person had been saying what a good potential opportunity this was, because that person seemed to believe in a GameStop as an actual company. Like, that person kept up with the fundamentals and was making a case for it. And then when that person was making a case for it on Reddit, it seemed to take on a life of its own, and people seemed to want to invest in that company, whether they were kind of playing with it or not, hard to tell. But it seems like a lot of people got inspired, and we don't know if it's really collusion or not, because it's a bunch of internet strangers who all somehow decided to simultaneously invest. So it's probably difficult to say that they were all conspiring somehow to bring up the stock price to thwart the efforts of some Wall Street hedge funds that were trying to short GameStop. So this is a long-winded way of saying at the time the price was pretty low, and there were some famous investors like Michael Burry who might have bought it at something like $6 a share, which was pretty cheap. Like, don't quote me on the exact price, but for the people who saw the value in the stock, they paid a low price because they thought there was more value to this company. But then the people who bought into it when it was in the hundreds of dollars, they no longer were necessarily seeing the value. They just wanted to join this crusade and, just stick it to the man. So they didn't really maybe quite see that there was an entry point at which it would have made sense, maybe if you're a true believer in the company and you were studying the fundamentals, as opposed to just the speculation price that a lot of people joined in later at.
The danger of jumping into a stock where the price is going up and jumping on that momentum is that you're gonna get into the stock on the top of the stock price. So the important lesson here is to really know what the company behind the stock is worth, because a lot of people, they don't necessarily think that stocks have any intrinsic value. A lot of people trade stocks, as I mentioned earlier, by looking at the stock chart and looking at the price today. And if the price movement is going up, they'll buy into the stock. If the price movement is moving down, most people would likely be looking a little bit, waiting, or should I buy the stock in 5 minutes? I'll wait 10 minutes more. And then just, buying the stock today instead of waiting until the stock is actually priced at a level where it makes sense. And I know this concept can be incredibly difficult to understand when you've always traded stocks by, just buying the stock at whatever price. And it's also what you primarily see out there. A lot of people follow this. It's called the efficient market theory. And what's meant by that is that stocks are always priced based on the information that everyone has available out there. So the stock price is always correctly priced. But as Warren Buffett style investors, we don't agree with the efficient market hypothesis.
What that seems to suggest is what's commonly taught in a lot of universities and probably practice on Wall Street and with wealth advisors is they will say, you can't really get an edge. Someone like Warren Buffett is a lucky monkey who just got to be able to get really rich because he got lucky at picking stocks. But what others have tried to say is that Warren Buffett isn't just an anomaly or an outlier to everybody else. If you put in the work to study companies, you could potentially get comparable results to some of the best investors out there, but it requires hard work and a little bit of conviction of what you believe in and sticking with what you believe and not getting rattled by, like, a lot of people will easily see the price of their stocks going down and then that scares them and then they want to sell out. Like, it's happened to all of us, like myself included. So that can be something that, if you don't really know why you're in a stock and you're just like, oh, I like this company and it seems like it's at a good price, I'm going to buy it at $100. And then, oh no, it went down to $95. Like, maybe I should sell. And then you kind of get scared and you're so hurt over losing $5 per share. But really, if you think long term and if you did your homework and you studied this company, you would know that this company is really worth $1,000 in X amount of years. And then if you lose $5 on within a trading day, you didn't really lose it as long as you didn't sell the stock. So if you can think long term and hold on and not be scared into thinking you need to sell the stock, you could reap the rewards many years later as long as you hold on to that stock and know that it was going to grow. Like, it's kind of hard to predict with some companies where they're going to be, but that's what Buffett tries to focus on. He tries to have some level of confidence in stocks. Like, he would always say, something about how people chew gum. Like, he understands like a gum business. So he doesn't think, technology is going to make people change the way they chew gum. So he's capable of understanding a gum chewing business. So if you think about stuff like that, you want to see some companies that are consistent no matter what the latest and greatest and technological changes there might be.
Yeah, one thing that's important though that, to say is that you shouldn't hold on to a stock because it went down and then you're holding on to the stock. You kind of need to understand, okay, what is the company behind the stock worth? Because I also see a lot of people that are holding on to stocks where the company is so close to bankruptcy, which is also, a terrible situation. At least here, what's going to happen is if the company goes into Chapter 11 bankruptcy, you're going to need to hold on to that stock and not be able to sell it. And your brokerage firm might actually charge you a fee for having that stock in your portfolio. So the stock is worth nothing. It is absolutely worthless, and you're paying a fee. And that's why it is, another reason why it's so important to know the price. And there are many different ways of calculating the price of a business. I know that Benjamin Graham back in the day, he would look at the company's PE ratio, the price earnings ratio, and from that calculate the company's value. But there are other methods out there. One of the most known method is discounted cash flow analysis, which is taught in many business schools, and you can find the formula online to figure out what is the company worth. And there are so many different methods out there that you can actually calculate the company's intrinsic value, and by that finding out, okay, so this $3 stock, in reality, it shouldn't cost more than $0.3 or 30 cents. Or this company that actually is, where the stock price is up at $1,000 is actually worth $3,000. So, if you do that and if you learn how to do that, it'll actually help you. And also knowing that this price is expensive and this price is cheap. What's important to know that whether or not the stock price is cheap or expensive doesn't matter if it's a bad quality company that you're looking at. Of course, you want a good quality company, which is also the type of company that Warren Buffett invests in. Back to your point of understanding the business, like he said, Michelle, about you can understand a business that produces gum because technology won't change the way that people chew gum, just as the example that you mentioned. Do you have any, thoughts or comments on my long chat here that I
Yeah,
had my monologue?
right. So yeah, like you were saying, instead of just blindly assuming that the stock market is giving you the correct price all the time, like efficient market theory would have you believe, you can actually be in the know. So, you can assess whether the $100 stock price, if that is a good bargain or if you're paying way too much. And we all do this when we're going shopping, when we go to the grocery store, you might compare, is $3 a pound for some burger meat, is that a good price, or are you paying too much for the ground beef? So you have to think about like what price per pound is acceptable to you when you're buying your groceries. And so when we think about evaluating company stocks, like Sina said, we've also learned another form of discounted cash flow analysis from the towns, like Danielle Town and Phil Town have taught a lot of their version of discounted cash flow, and they base some of it also on this owner earnings formula that Warren Buffett has shared with people. And the way that Warren Buffett has shared it out to people, you could read about it in annual reports. But if you don't have it pointed out to you, you might not realize it right away unless you come from an accounting background or you're just so into financial information that you immediately know that that was there. But if I would have just read Buffett's letters without having come across the town's books, I might not have realized, what the owner earnings mean. So it kind of helps to have some of these like more beginner level introductory books, like the Invested book from Danielle Town, to help you know how you can go about it. And I really like how she spelled out in a step-by-step way how to do some of these calculations. So, there are resources out there. Like we happen to, sing the praises of the town's information because I think it makes investing way more accessible than other resources out there. But I'm sure there are other things that you can go off of, like Another book that I liked in reading was from Peter Lynch. He used to be a mutual fund manager at Fidelity, and he came up with One Up on Wall Street. And I thought that was a pretty good book as well, with keeping in mind some criteria that you can use to value businesses. So it might not be in a formulaic way, like X plus Y equals Z. You might not have some of that, but you have more qualitative things to think about. So that's where I would suggest some people can use some of these resources out there to help them in some of their valuation. And, there's not just one valuation formula and that's it. There are so many that you can use that you get a sample. Let's say you use 3 or 5 valuation calculations. So you get an overall picture of, is a stock price even near the ballpark of any of these values that you might end up with.
And when Michelle talks about, 3 or 5 different prices, in the investing community, there is also a lot of talk about which formula is correct. And, all sorts of different businesses might, benefit from different formulas. So it is important to understand the business, as we've talked about, but also in that way where you can say, okay, I'm going to use this valuation formula for that business, whereas this valuation method isn't that good for a cash flow heavy business or something like that. It really depends on the business. There are many resources out there that can help you fast track some of this so that you do it faster, like Michelle mentioned, and we'll make sure to actually link to some of these books in the show notes. But there are ways where you can get this knowledge much faster, get this information faster, so you don't have to, search the mountains of information that you find online. And I believe it was the 1986 annual letter that Warren Buffett mentioned the owner's earnings formula, and that's one you can read too, even though in my opinion, when he shares that formula, it's not easy for people that are new to the Buffett style investing to actually understand what exactly is it that he means. I know that from reading his annual reports over and over again over the years, and as I get more knowledge, it's easier to understand. But in the beginning, when you read something like that, you might not quite understand, and that's why getting some help or reading some books is the right way to go about this, where you can kind of fast track through that information. The essence of what we're talking about here today is that there's a way to not jump into a stock when it's super expensive, not meaning that you'd have to give out more of your cash, but meaning that the stock actually might be more expensive than what's actually, the company is valued at. And that's the reason why we discussed GameStop to begin with, because that's a great example of something that definitely was way overpriced at some point, and where some people lost a lot of money because they weren't mindful of what is the correct price for this business, at what price should I buy this business for, but jumping on the momentum instead.
Another thing people should be mindful about is less expensive all of a sudden just because they do a stock split. And what that's really just saying is they're dividing the pieces of the pie into smaller slices. So let's say you had a big slice of pie, like $2,000 is your slice of pie. And now if they split it into, say, $150, you're getting several of these slices of your original $2,000 pie. So, you get a handful of slices as opposed to the original one slice, but you still have the same total amount of what your ownership in the company was. So you actually would get less. So if you invest in a company that one share was $2,000 and later on you bought only one share at $150, you actually didn't invest in the same amount of company. You only got, proportionately a smaller amount of the total company pie than you would have thought. So just keep that in mind, because sometimes on the Dow, I think some of the companies I've heard play a little bit of a game where they don't want to seem like the most expensive based on a nominal value. Like on the Dow, the most expensive looking stock right now would be United Health Group at $521. And the second one would be Microsoft at $388. So if you think about some of those, they might seem kind of expensive, but maybe Microsoft might play a game someday and then do a three-way split, and then you're paying only $100 something per share with Microsoft. But now their stock just seems a little cheaper, but it's only because they split the company into more shares or more slices. So it doesn't mean that just because they did a stock split, does that mean that they're cheaper? They're not necessarily, they're just nominally reducing the share price. But if you owned a bigger slice, like I said before, now you might just have a bunch of slices later on after they've done the split.
Great that you bring that up. That's a perfect example also of how, some businesses actually decide to do a split to, make people believe that the stock is cheaper. And then now I can afford the stock now that it's, seems to be cheaper than earlier. So that's a great example you came with, Michelle. We're coming towards the end of the show today, but thank you so much for listening in, and remember to share this show with your friends if you found this episode valuable, and we'll be back on Tuesday.
Till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.